Welcome to the Off the Record podcast, Kyle Sells Biz Off the Record, where we bring on guests that have expertise in all aspects of mergers and acquisitions and business sales. You either tuning into this podcast because you're thinking about selling a company or buying a company, or you're an advisor representing clients that are in need of various mergers and acquisition services. Every week, every Wednesday, we bring a special guest that's expertise in different aspects of growing, prepping a business for an exit. Today, we have a special guest, good friend of mine, Jim Vigna. He's the Senior Vice President of Live Oak Bank. He has over 20 years in experience in banking. I've come to know Jim over, I would say, been 5 years now, Jim?
Yeah.
So Jim works with our company here at MIBB Group, which I'm the partner of. He's also one of our go-to lending resources for our team at M&A Network, which is a team of advisors that support business owners that are in transition. Prior to joining Live Oak, Jim worked for one of the largest banks in the country and was the top SBA lender by volume. And he has brought a lot of that track record and success to Live Oak Bank, where he leads a team where he covers the Northeast and he helps business owners with acquisitions, partner buyouts, expansion, new construction, and so on. If you have tuned in to our podcast in the past, by the way, we are streaming live here on LinkedIn Live. We also streaming live on Facebook as well, Twitter, and YouTube. Do share your comments and your feedback in the comment box. And if you have any questions, we will get to those at the tail end. And for those of you that have joined us in the past, so if you're new to the podcast, we tend to keep it light here, and it's called, off the record for a reason. We just want to have off the record conversations. It's on the record, but still off the record. But we want to have light conversations where we essentially protect the innocent, because what's most important to us and our clients is keeping all what you share confidential. But SBA has been big in the news lately, especially with some new developments, which we'll get into. But typically in our session, I like to learn a little bit more about our guests, a little bit more about their background. So I like to, introduce Jim, have him share a little bit of his personal journey and how he got into the world of SBA lending. So Jim, welcome to the podcast, my friend.
Thanks, Kyle.
So tell me, what makes you, you've been doing this for a long time. Like how do you get involved in SBA lending? What kickstarted for you?
Yeah, like probably most people's career, that happens by accident, right? You just kind of fall into it, and then you like it and you just keep going. So, I graduated from Lehigh University in 1995, and I got into banking, and I got into a management training program at a regional bank called Statewide Savings Bank in Jersey City, New Jersey. And I stayed there for 3-4 years, and then I took a job with a bank called First International Bank, and they were the first SBA lender I ever worked for in 1999. So I learned that business there, built my referral source network, really on-the-job training, business development 101, and built my business from there. Things really picked up after a couple of years of really building that. Things picked up. Most recently, prior to Live Oak, I was 8 years at TD Bank. Great bank. Those were great years there. But in 2019, I was approached by Live Oak to grow the market presence in New York. We are doing nationwide deals. I'm doing nationwide deals, but I reside here in the New York City market. So they brought me on to really grow that business, and we've done that. So it was a great opportunity to join the largest SBA lender in the country, and it's been the best 4 years of my career.
Yeah, Live Oak, I don't want to say you guys came out of nowhere, but you guys did. You just came in and, you had a different approach and to your process. And I always tell folks, and this might be contrary to what you guys are talking to Live Oak, but I think having a banker that really understands the business, takes the time to understand the business is key. A lot of banks are really good at processing loans, but you're going to make sure that the personnel that you're working with and everyone that have come in contact with a Live Oak, especially yourself, Jim, really takes time to understand the business. And you tell folks as it is, right? If it's not going to cut it, you let them know you're not going to waste their time or their money, trying to get a loan that they're not be able to, not going to qualify for.
Yeah, no, exactly. And we know what we do well. We like business acquisition loans. We're by far the largest business acquisition lender in the country. We do 22% of all SBA business acquisitions over $1 million. So it's a very big number when you're talking about 1,500 lenders being out there. So being a high volume shop, it's easy. We definitely are very tight on what we tell people we do in our sweet spot. And if you do that, you get back what you are telling them that you like. You know, the worst thing I can do is just say I'm an SBA lender, and people just send me deals that we don't do. So we take in the deals that we like. It's a quick yes or a quick no, which borrowers actually like. Even if it's a no, it's fast, and they can move on and find a more appropriate lender to go to. So we really pride ourselves on that. It's part of our success, I think.
Yeah, I like that because it helps us as M&A advisors and brokers, because sometimes the client need to hear that from a third party. You know, at a meeting yesterday at my office here with a respective client, and you know, sometimes the numbers doesn't add up as it should. And typically when you're going to get qualified for SBA loan, you look at the tax returns, right? That's the buck stops there. And it is a reality check for a lot of businesses, right? If you're looking to prepare for an exit, you want to make sure you have your numbers and have all of your financials in order by the time you get to Jim and Live Oak. I have a question. You know, you've been doing this for a long time. Like, what do you find the most rewarding about the work you do in SBA lending?
Well, you know, it's helping entrepreneurs fulfill that dream of buying and also selling. I mean, the seller, this is a huge event for the seller as well. A lot of times they've owned this business for 40 years, and 90% of their assets and their net worth is buried in this business. Mm-hmm. And when they can kind of realize that liquidity event, it's a huge event in their life. So we're that third point in the triangle between buyer and seller, and us getting involved and helping to get a deal done really kind of makes two dreams and reality come to reality.
Yeah, I mean, you're creating, you're helping create a lot of legacies, right? You know, one of the biggest challenges with business, whether you're starting or growing, is getting access to capital, and like it's just very fulfilling to know that you're part of that part of that spoke in the wheel that helps businesses get their first start or help them expand. So yeah, I can definitely see a lot of that. Let's get into more of the basics of SBA lending. I know at this point it's a lot of folks are aware of it, but there's still some mechanics about SBA that a lot of people don't understand. I've had multiple conversations with business owners that are just don't want to go through the rigorous process of getting an SBA loan, of expose themselves and all the paperwork that's included as part of the process. But maybe you can probably demystify some of the the myths, so to speak, that come with SBA lending. So what's the purpose of SBA lending, and how does it support small businesses? We can start right there.
So the purpose of SBA lending, it's a government-backed program, which is designed to help finance small businesses where conventional financing is not available. So it allows the borrowers to understand a real estate deal. You could do 100% financing on a owner-occupied commercial real estate purchase for your business. If you think about that type of deal, if somebody's buying a property, they're usually growing. They might be renting in 5,000 square feet and they want to buy 10,000 square feet. They're growing. So if we can get them in without them putting all their free cash into a building for 25 years and keep that free cash to help build their business, which is theoretically growing if they're buying a building, that's much better for them. So it's attractive to them. And on business acquisitions, it's a 10% down product. If you can buy a business for a couple $1 million and put 10% down, and we can facilitate the change of ownership and the continuing of that business, that's a good thing. And on the bank side, the SBA program is great for the bank. So we lend all the money. All the SBA does on an SBA 7A loan is guarantee 75% of the loan. So it allows us to be a little more aggressive and give us a comfort to lend at a higher leverage, like 100% financing on real estate and business acquisitions, which are usually very collateral light deals. People are buying cash flow, they're buying goodwill. So we kind of look at that 75% guarantee as a bit of collateral for us. So if we lend $4 million, It's 75% guaranteed. So our net exposure is really $1 million. So there's a benefit to the bank and there's a benefit to the borrower.
Yeah, that's actually my follow-up question to you was some of the key differences. You just point out one. And anything else where you can help folks understand what's a major or key difference between SBA loans and traditional bank loans?
Yeah, so SBA allows for startup deals. It allows for projection deals. I'm not doing the numbers now, but if you can give me this money, here's what I'm projecting I could do if I had the financing. So a traditional bank is probably not going to be interested in doing a startup or projection deal conventionally, with no assistance from the SBA, no SBA guarantee. So that you'll see a lot of startups and projection type deals go SBA where that's not available from a traditional bank loan.
Mm-hmm. Interesting. What about some of the requirements and qualifications? Is there a difference between the two as far as getting qualified?
Yeah, I mean, conventional lending is a little more open as far as nonprofits, things like that. So the SBA product is for-profit businesses only.
Mm-hmm.
You need to have historical cash flow or projected cash flow with debt service of 1.15 minimum. So you don't have to have it now, but you have to have a projection that's done well, that makes sense, that shows that if I can get this loan, I'm going to be over 1.15. You must be a U.S. citizen. It must be a U.S. business. You can also have a green card for anybody. If there's 51% ownership or more with a green card,
Mm-hmm.
individual with a green card, that's eligible. And then all banks have their niche as far as eligibility of the people with the types of deals that we want to do. We're acquisition lenders, business acquisitions, owner-occupied commercial real estate acquisitions. We don't like bankruptcies. Generally don't do startups or projection deals. We do deals for cash flowing businesses. And what we do is when we have a cash flowing business, we get very aggressive on structure.
Mm-hmm.
That's where we kind of win our deals. But there's other banks that like smaller deals. They like the startups or the projections or turnaround deals. So different flavors for different banks.
Awesome. Talk a little about the process, right? And you could probably include some best practices in there. So can you walk us through the process, like the SBA lending process from application to funding, and what does that look like?
Yeah. So the SBA reputation, in the past has always been it's cumbersome. It's a tough process to get through. So over the years, I've been in the business now a long time. The SBA has taken steps to make the process easier, simplifying forms, changing policy, making it a little more open, allowing banks to have a little more authority to do things under the SBA policy on their own. So that's all happening. So we've been 5 years as the number one lender in the country, but banks come in and out of the business. Some are aggressive on deals. Some get into the business and then they venture off into other things. We're kind of playing the long game. We're staying true to who we are and what we do. So I think we're here for playing the long game and doing the deals that we like, that we think are going to do well and pay us back.
Talk more about that initial conversation, right? You have someone that's looking to name the business, let's say HVAC company, right? What can they expect from you from that first conversation, or what should you expect of them rather? Like, what are some typical questions you ask to pre-qualify candidates that are looking to get funding for SBA lending?
Yeah, my advice would be, be prepared. Have your ducks in a row. Like, know your story, know your numbers, know what the goal of this financing request is, right? Know the why. There's reason. The business, you know the numbers. The business has gone up or margins have gone down. Like, all those questions are going to be asked, and if you know the answer to that when it's asked, it's going to be much more impressive to the bank that you have a good handle on your business. So preparation, I think, is critical. Don't wait till it's too late. Don't look to borrow money when the ship's sinking. Look to borrow money when you're doing fairly well, so you can prepare yourself. If there is a downturn, get that line of credit in place, so it's there if you need it. A lot of people wait and use a loan as more of an SBA loan more as a last resort, and those are really hard to get, certainly at a reasonable rate.
I like what you shared about the why aspect, right? So when I'm pre-qualifying buyers for my clients' businesses, there's three things I look at. One is you can't get around it, right? Do you have the money or access to money? Like, do you have liquid capital? Not some money sitting where it's your uncle or someone's or you're going to be sending you wiring you some money, but having access to capital, having enough to make a down payment. So especially with SBA lending, there's opportunities to put down 10% and leverage that to buy a company. The second thing I look at is going back to your why aspect is, the knowledge, like what transferable knowledge you have in that particular sector, and why do you want to invest and name the business to begin with, right? What's your motivation? What's your drive? Because, a lot of these deals don't really get to the finish line, either buyer, seller, or other components, sort of variables, that intangible issues that come up. But the why of why this business and why you want to buy this business is definitely key. So the motivation is a huge factor. So I love that you brought that up. What are some of the common challenges? And I see some questions coming in. We're going to get to that in a second. Thank you guys for chiming in your comments. What are some of the challenges that businesses face when seeking SBA loans? And what, give any points of advice you can share with folks that are trying to get financing?
I think the challenge a lot of people have is finding the right SBA lender. Again, there's over 1,500 lenders out there that did at least one deal. And even if you take the top 50, they all have a different niche. The loan amounts that they like, the type of deals that they like, whether it's real estate, whether it's business acquisitions. Some like the tougher deals that are more debt consolidation, permanent working capital type stuff. So know what you want and need, and try and find the right lender, whether it's online Google searches, call your local SBA office, because every lender is different, and every lender is not the catch-all for every SBA deal. It's a big world out there, and everybody has decided to take the SBA SOP, interpret it in their own way, and implement how they want to use it at their bank. So I think finding the right SBA lender is really a big challenge.
That's true, because you guys come in different sizes and backgrounds, and actually want to get back to a question that when you was first laying out as far as exposure goes, I know there's some opportunities for folks to get financing above SBA limits, which is at 5 million. But you had mentioned that we're going to get to some of the nuances of SBA, the new SBA guidelines, but I know typically SBA insures up to 75%, and it kind of gives you some comfortability as far as how much you can lend. But talking about that, so what are live oak parameters? Like, where do you feel comfortable at as far as lending? I know some banks prefer to stay within $3 to $4 million range as far as deal size. Where do you feel comfortable most at getting deals done? At what price point?
So I think about 75% of our deals, I would say, are business acquisition loans. Now, within that space, we like the $1 to $10 million deals.
Okay.
We feel like $3 million is actually almost easier to underwrite than $300,000. There's more. The numbers are a little more reliable. The CPAs involved generally are a little more high level. Numbers are most accurate on the larger deals. There's more analysis going into it. So we prefer the 1 to 10. And the way we get to that, so SBA goes up to 5 million, and we'll put conventional money on top of that to get to some higher numbers. And that's really one of the reasons why we're the largest SBA lender by dollar volume, is because we like the larger deal.
Got it. And I just want to go back to one of my other questions, because I just want to kind of hammer this home a little bit on best practices. So as far as investors, buyers looking to invest in a company, outside of what you already mentioned, is there any other best practices you could recommend? You mentioned about being prepared, all the prep, knowing your why, understanding the business, and so on. Is there anything else you could think of based upon your experience that would help someone that's trying to get or pursue SBA financing?
Yeah, on the buyer side on a business acquisition, it's always nice when a buyer comes to us and say, I have this deal. I'm looking at. I've looked at the numbers. I've done spreadsheets on the return for myself and the adjustments, and I've done all my homework, and I want to pursue this deal. Too many times we get deals, they throw it at us, and they really haven't looked at it themselves or done their own analysis. It's always nice when somebody confidently comes in and say, I want to buy this business. This is why I want to do it. Because the trends are good. The numbers look good. There's no concentration. It's a 40-year business. They don't have a website. They've just done things the same way for 40 years. And I have all this technology thoughts, and have a plan to come in when you're talking to a bank, because when you have that plan, it's like, oh wow, this guy's really prepared. Because business acquisitions are, they carry elevated risk. That transition risk is that initial hurdle of coming in and running that business and not losing customers and keeping the culture at these businesses and keeping the employees is huge. That's the real risk of these deals, the transition risk.
Yeah, you just talked about a pain point there for me, culture, right? And employees, and you have these companies that are first and second generation. I'll reference back to a meeting I had yesterday. They have the vendors and even customers almost like family, extended family, right? So it's like you want to maintain those relationships, and yes, you want to sell, but you want to make sure whoever comes in and buys that business is going to do right by them and continue that legacy. So having those in-depth conversations with the owner of the business, understanding the framework, understanding the culture, putting a team together. That's one of the things we have done with M&A Network, is building a team. We have 43 advisors on the team, Jim being one of them. You want to put a deal team together, right, to help you analyze these deals. Not only having a legal attorney, but having someone who can come in and, once you purchase the business, the work really starts there, right? Once you get in, you want to get some ROI on your investments. There's a lot to it. Jim, I want to jump into some of the nuance of SBA and some of the things that have been happening as far as the new guidelines with SBA lending. But maybe if you want to set the stage as far as trends, and maybe we can talk about some of the trends that's happening now in the future of SBA lending, and we can jump into some of the new guidelines that just came out not too long ago.
Yeah, some of the trend. You want some trends in business acquisition lending?
Yeah.
Mm-hmm. So the big trend right now is the disconnect between high seller valuations and really high borrowing costs. So borrowing costs.
It's funny that I feel that was always an issue. Just now is in a greater scale now. I feel like the buyers are essentially have a price point, and you have this big range between buyer and seller expectations between what both parties want. But now with the cost of capital change, definitely makes it kind of funnels in on that. But I feel like we always had that problem.
Yeah, it's really exaggerated now. We have a slide that we show, and you've seen the slide, Kyle, that a business that was doing an SDE of $1 million a year 14 months ago could borrow $5.3 million.
Right.
Now that rates are up 5% from what they were, they can now borrow $4.3 million. So that's a huge turn of events, right? And when we tell people, we kind of simplify it, say a couple of years ago, a person making $200,000 could buy $1 million house. Today, a person making $200,000 can't buy $1 million house. It doesn't mean the house isn't worth $1 million, but there are less buyers out there that are eligible to buy that house. And that's the same thing going on with business acquisitions. There are people that want to buy businesses, but there's something has to change or happen between buyer and seller, whether it's putting in more money, valuations coming down a bit to bridge that gap.
That's a challenge, right? So if you're selling your business, there's a less the funnel of buyers is a little bit slimmer now. There's less buyers that can qualify to purchase your business based upon the doubling of the interest rates over the past, was it 5 years or so? It went from like
14 months.
I'm sorry?
The interest rates went down. Prime went to 3.25 March of 2020.
Right.
Stayed at 3.25 till March of 2022. So they've gone up 5% in 14 months.
Yeah. That's insane.
Big number.
But there's still opportunities for businesses out there to make money on that spread, and just being better at evaluating deals that you're looking at. So, and any other trends that we should be aware of as far as the new changes that are coming down the pipe with SBA lending?
Well, there's SBA has made, if you've been looking at the news, sweeping changes, big changes with numerous things. Some say too many changes all at once. The SBA has not been one for big change, right? So quickly, and all of a sudden we got a ton of change. A couple that come to mind, some are good changes. The personal resource test is now gone away. So in the prior SBA policy, if you were, just for example, if you had liquidity equivalent to more than the loan amount, you wouldn't necessarily be eligible for an SBA loan. That has gone away. So now you would be eligible for an SBA loan. So somebody with significant liquidity would now be eligible, which we think is a good thing. People with money do buy businesses and grow them and hire people and stimulate the economy. And from the bank's perspective, wealthy people usually pay their loan back, which is good for us. So that is a change. Another one that we think is going to be good for our industry is the partial buy-in. So change of ownership for SBA has always been 100% change of ownership. You couldn't buy into a business. The new SBA policy allows you to buy into a business now. So how that's going to work is, as we interpret it, because there's a lot of questions that everybody has for SBA that they have not answered. But what we believe is the policy is that you'll buy this business, and the seller, as long as he is left with less than 20% ownership, will not have to guarantee the loan. So he's going to be out as far as liability, and he's going to realize 80% or more of the value of his business, and he'll stay on for the rest. What's also different on a buy-in is the seller can stay. 100% partner buyout, the seller had to be gone within 12 months. Now he can stay as an employee or a stockholder, a director. So that'll be good for continuity, transition, keeping customers. So we find that to be a good thing. And then a change on the full change of ownership, which people are questioning, and has kind of gone back and has gotten a lot of attention in Washington, is the old SBA policy on equity injection on full change of ownership was that you could put down 5%, not 10%, and the other 5% can come from a seller note on full standby for the life of the loan of 10 years. That you didn't see that a lot because the seller doesn't necessarily want to wait 10 years for that 5%, but you did see it, on some deals. Now the new policy is the seller can account for 100% of the equity and only be on a standby for 24 months. In essence, a buyer can come in and put no money down and buy a business.
Yeah. So
the banks have kind of said that sounds a bit odd, that you don't have to put any money in and buy a business. So banks will interpret that differently. The banks are free to put their own credit policy on top of the SBA policy.
Right.
We have no guidance on how we're going to approach it. Again, it's kind of gone back to Washington, and there's certainly conversations about whether that was a good idea. So we'll find out more about that. So those are the main ones. There are others, but those are the main ones that we think are of note.
Those are big, and is actually, very helpful for SBA space and for business brokerage and sales of companies in general. Because one of the biggest challenges has always been in the owner, right? If the buyer wants the owner to stick around plus 12 months, now the SBA has changed those guidelines where they can remain an owner, have some equity in the company, and I believe it's up about 19% ownership before they actually become a co-borrower and have a guarantee on that note. So
Yeah.
that's a good change.
Yeah, what I think we'll see. What I think we'll see is a lot of 81%
Yeah.
acquisitions. Bring the seller below 20%.
And I share this sometimes. I'm pretty much conflicting in what I do, and I share this as like, I look at a business as like, why do you want to sell your business to begin with, right? I look at, like real estate always goes up in value. Same thing with stocks. Selling your business is really a last resort. So if you can bring on a partner, essentially come in and have that partner have some resources, run the company, you can maintain some equity in the business, grow the business, and actually you can make money twice, right? You can sell off some of your interest in the company, have that buyer come in, grow the business, and then you can sell it again. Sell off your remaining shares.
I think also one, the problem we talked about with rates being up and it's harder to cash flow deals. And if you're only buying 75% of a business or 80% of a business, you're borrowing less. So it could put deals back into formula as far as getting a bank loan. So that may be very helpful to kind of bridge the gap and allow people to buy into businesses. Maybe you're not buying the whole thing. Maybe you're buying 80% of it.
And then the 24-month hold is a big one too as well. Instead of 10 years, that's a big difference.
Oh, huge. Yeah. So change has come, and it's come with some controversy. So, one, we have questions to the SBA of like how we're interpreting all of this.
Yeah.
And we don't have answers. And now, Congress is kind of making a lot of noise on both sides of the aisle that, too much changes is happening. So, more to come on all of this.
Yeah, we have had some deals hold up just because the bank don't really understand the guidelines, right? So it takes some time to go through everything.
Yeah.
We have some questions here. I know we have some time to take some questions, Jim, but I believe you mentioned earlier about you have a LinkedIn user that asked, what does that mean, aggressive on structure? So I don't know if you're still around, you want to restate that, or Jim, if you understand the premise of that question.
Yeah. So we our business acquisition product, we find somebody we like who thinks who can transition in and run this business and grow this business. And if we have a business that cash flows, we will get aggressive on structure.
Mm-hmm.
We'll go with the full 90% financing. We don't have to require seller notes. We'll get aggressive in winning that deal. If we need to have a lower rate, we have the ability to do that. And with our process, for us, speed and execution are two main strong points. We're fast. We get the deal in front of our credit officers within a couple of days. We have one signature credit authority, so it allows us to go to the one person we need a signature on in a couple of days. And our execution from term sheet to commitment is 96%. So we get aggressive in structure, and we get aggressive in getting the deal off the street.
There's actually a question I have for you that I'm glad you brought it up as far as speed. In light of COVID and all these changes that are happening, I mean, it's tough for you to answer this question, but typically on average, how long does it take to get financing for SBA transaction?
Well, we're fast. So our application to close averages 42 days.
Mm-hmm.
That's well above the average. We're a service. We know what is lacking in the banking industry, and we kind of attack that with service. So, treat every customer like the only customer is written all over our bank. You literally have to drive under a huge sign that says treat every customer like the only trust customer, go in our parking garage at our headquarters every morning. They're serious about it. Everybody from credit to closing is on board with that and has directives to move things along quickly. So that's really.
And I mean, you guys are fast. I mean, Alex is in your team. He's one of your underwriters there. I mean, he turns things back around to us pretty quickly. So I can vouch for speed and Live Oaks Park. There's a question that came in around debt service coverage ratio. Can you talk about that?
In the general, so we have 30 verticals. So we have the business was built and started in 2008. All we did was lend to veterinarians, and we went to pharmacy and death care and things like that. So certain verticals we have a 1.25 debt service coverage on business acquisitions. In our general industry environment, we target 1.5 times, and when we have that, we get pretty aggressive.
What are some of those verticals that have the more favorable rates, ratios?
I think self-storage, the medical stuff, dental, pharmacy, the investment advisory. I can get you a list of that, but
yeah, that would be great because we do have
the safer and the better the statistics of repayment ability, the better, the stronger the debt service number gets.
Yeah, it'd be great to have a short list of industries that have a lower risk tolerance for the bank. We can share that with everyone. That'd be wonderful.
Yep.
We have a question here. Please confirm earnout deals are prohibited by SBA on the $1 to $10 million. What is the EBITDA range?
So earnout is a bad word in SBA. It's almost like it's not a 4-letter word, but it is a 4-letter word in SBA. So the same result is achieved by a seller note. So if you are looking to, if you buy a business for $4 million and you have an earnout that can get you to 4 or 5, with a seller note or performance-based seller note, whatever you choose, you can have you buy the business for 4 or 5, and then you have a performance-based seller note, and if the performance occurs, you'll get the 4 or 5. So it's almost like a reverse earnout. You buy it for that larger number, and if those numbers are achieved, you get that 4 to 4.5 instead of buying it for 4 and end up getting 4.5. And the reason why earnouts are not allowed, so SBA requires 10% down. So if you put 10% down and bought a business for $4 million and you had an earnout and you ended up getting 4 or 5, you now put in less than 10%.
Right.
But you won't know that until a year or two down the road. So all the same things can be achieved through a performance-based seller note.
Point well taken. He also has a follow-up question about the range. This might be a tough one to answer, right? Based upon the size and the business itself. But he wants to know what's the average, I guess, EBITDA range on valuations between 1 to 10 million.
Average EBITDA range?
A $1 to $10 million deal. What's the EBITDA range typically you're seeing?
Oh, so I'd say 250 to 2.5 million. That's very back of the envelope, 4 times multiple.
Okay.
Different industries have different multiples, things like that.
Yeah, that's a depends question, right? That's a follow. Yeah. That's a follow with me. Send me a direct message.
That's a long way to say it depends.
Okay, what we have here? How much pressure are you seeing on multiples due to the increase on rates?
I will say I thought there would be more pressure on multiples. Rates have gone up significantly, and multiples have not changed at the same level. I think business multiples are down a bit, but not. They've held pretty well. In this environment, businesses did well in 2022 generally.
That's true.
What we are seeing a little bit now that we're getting first quarter numbers, we are seeing that generally, it's not sweeping across the board, but we are seeing, we look at Q1 23 versus Q1 22, 23 is weaker.
Mm-hmm.
And we're in a different time.
Yeah. Because businesses have been rebounding, so they benefit from a lot of either the slowdown previously due to COVID. So you have that big spike, and I've seen that in some of my clients' businesses where the tail end of 21 and 22 they're done pretty well, and then 23 they're starting to level down and get back to what's more of a baseline. So from my perspective, multiples has softened a little bit. It had peaked a little bit, but I think it's starting to flatten back out again. I think what's key is due diligence, right? Making sure numbers checks out and makes sense. You can actually hold the valuation, so to speak.
Yeah, I think right now, if buyers and sellers are interested in striking a fair deal,
mm-hmm.
the deal will get done. If both sides or one side, only has to be one side, is too aggressive on their position and isn't willing to give anything, it's going to be difficult.
Yeah, that's like with anything, right? So it goes back to understanding the data. So when you negotiate and you want to understand what's at hand, and I look at things from the other person's lens as well, right? Yeah. From the buyer looking from the seller's lens, seller looking from the buyer's lens, and hopefully it's a happy medium somewhere where both parties can meet. This has been a great session, Jim. Always appreciate your time. Always love having you and connect with you. We'll begin together in the city on June 27th. We have a rooftop venue and bring together all the top M&A minds, top brokers, top deal makers, attorneys, advisors, and Jim as well. If you want to meet us in person, great time to come out. We'll share a link where you can join us in Manhattan on June 27th. Jim, do you have anything that's coming up with Live Oak? I do always love your reports. I'd love to get some of the information we can share with folks that are tuning in. But anything coming up that Live Oak is doing or yourself that you like to share with everyone?
No, what I will share, we are in business. We have not changed anything in how our credit policy and how we're doing things. A good deal is a good deal. You can reach me if you'd like to speak about a deal at jim.vigna@liveoak.bank or phone 973-886-5052.
Thank you, Jim. We want to share your information with the show notes. And anyone's looking for information on buying or selling a business. So this one to get your business evaluated, be sure to reach out to us at the NYBB Group. We have been doing this for 20 years, and we think we have an idea of what's happening in the marketplace and tend to lean on the expertise of our professionals, with Jim here included. So stay tuned. Next week, we're talking about, guess what? Business valuations. We have Todd Ringler going to be joining us. I'm actually meeting up with Todd tomorrow, Jim. We are doing a exit readiness, preparing a business for exit tomorrow at the Heritage Club. Have one of my past clients going to be joining us, just talking about the process and some tips and tools. Because I think information like this is great for business owners to know about the process. The more they're educated about what's involved, it just makes everything smoother, down the road. So, education is key. Best practices and learning from folks like Jim and others, what's needed to close your loans and get deals done. So appreciate you, Jim. Thank you as always. And looking forward to seeing you in the next few weeks. I know you have a busy June.
I do. Yeah, I do.
Family and your kids, graduation and all that cool stuff.
Going on. I appreciate the time.
I thank you. And thank everyone that chimed in, and look forward to getting the show notes out to everyone. Thank you.